Good morning, everybody, and welcome to this particular session. And today I want us to look at why ICT entries fail without higher time frame bias, because it's very important. This common adage that says the trend is your friend, that should always be the norm when it comes to trading or in the financial markets. The trend is always your friend. Okay, it should be always your friend. So you realize that sometimes for those who do ICT, you know that there are sometimes you can have a perfect ICT entry, a perfect time, right? Perfect confirmation, and still lose. Okay, so because your entry was fighting the higher time frame. And what you need to understand from my interaction with the different traders is that many traders focus on entry models such as fair value gaps, order blocks, liquidity sweeps, etc., etc. But they ignore one critical factor: higher time frame bias. So in this particular video, I'll explain why even best setups fail without alignment and how to fix that. Okay, so this video will be probably for those traders who use ICT or smart money concepts, get clean setups but inconsistent results, feel like entries work sometimes but fail randomly, or probably struggle to align multiple time frames. So what you need to understand, anytime you open your chart, what you need to understand is that even before you open your chart, you need to understand that entries don't create hedge. Buyers is the one that creates an hedge. Okay, your buyers, the buyers of the market, is the one that creates an hedge. Okay, that is what is going to give you an edge. And with that understanding, right, with that understanding, therefore, you need to understand that entries only execute it. They execute the hedge. Okay, entries will only execute it, right? So, and when I talk about higher time frame bias, what do I mean? So higher time frame bias is the overall direction expectation based on market structure, liquidity targets, trend direction, and higher time frame zones. Okay, like in this case scenario, you can see here all the way from this particular point. All right, let me mark here. So I'm using my premium and discount tool to mark all the way from here to this point. We have a bullish movement, right? We have a bullish movement all the way to this particular point, all the way to that high. Here, the market was bullish, right? The market was bullish. Okay, so as you can see, initially we were looking at the market dropping. This was a bearish market, but then the market started pushing on the upper direction, bullish. Now, with that understanding, what you need to look at now, also we are looking at the liquidity targets. Remember, I did a video about liquidities, right? Here we have equal lows, right? These are equal lows, and the market comes and sweeps out the equal lows. So these equal lows, these are the sell side liquidity. We also said that these are sell side liquidity. They are also what we are calling the external, right? External liquidity. So when an external liquidity is swept, we usually see the price now go to the opposing external liquidity. So here, this external liquidity has been swept. So where do we have an external liquidity? Sell side liquidity. So now from there, we look at the shift in market structure, which happened at this particular point. As you can see, that particular level, right? So there we have a shift in market structure, very clear. And then now we align ourselves in the bullish sentiment. Okay, we align ourselves in the bullish sentiment. Okay, so that is very, 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 very important to understand. So now, where are we targeting? Even on the daily time frame, where is our target? See, we have this external liquidity, right? That's where we have the buy side liquidity, right? So that is BSL, buy side liquidity, which is also an external, right? An external. How do you write external? My goodness, external. All right, external liquidity. Okay, so I believe you have already watched the video I shared about external vis-a-vis internal liquidity, so that it can make sense. So that should be the target. So we start now programming ourselves in the bullish aspect. All right, but now So we have that. We have confirmed the market structure, bullish. We have confirmed liquidity targets, right? We are targeting the buy side liquidity. We have confirmed the trend direction. We are bullish. And now we have that. So this will help you to answer the question, where is price likely going to, right? And if you look at it from here, the price is likely going to this buy side liquidity, right? So without this understanding, you'll basically be trading blindly. So you may have a valid entry, but in the wrong direction, right? You may have a valid entry, but in the wrong direction. So why do these entries fail? Let's say probably higher time frame is bearish. Price is targeting lower liquidity, or maybe probably, yeah. So, but on a lower time frame, you see a bullish fair value gap, a small structure shift, a clean entry, you go long. What happens is that price reacts slightly, then continues down. The entry worked locally but failed globally. And that's the difference. That's the difference that you need to understand. Like for instance, in this case scenario, higher time frame is bullish. Price is targeting upper liquidity or the buy side liquidity. So on the lower time frame, maybe probably you go there and see a bearish fair value gap or a bearish order block or a small structure shift, a clean entry. So you go short. What happens? Price reacts slightly, then continues up. So the entry worked locally but failed globally. And again, that's what I'm saying. That's the difference that you need to understand. So that now tells you there is the need for the multi-time frame alignment. And in this particular multi-time frame alignment, think of it like this: higher time frame direction, all right? Higher time frame will give you the direction, lower time frame is for execution, because higher time frame tells you what to do and lower time frames tells you when to do it. So when both of them align, probability increases. But when they conflict, there'll be a lot of confusion, right? Confusion will increase. So now with this one, I will give you 3 steps framework for alignment, because you are seeing what I'm trying to say is that alignment is very important, higher time frame and lower time frame. So I have already identified this. So the first step is identify the higher time frame structure. So I've already identified this. I've looked at where the price is likely to go. I've also shown the premium levels and the discount levels, right? So remember, even if you are going bullish, we are only going bullish on the premium, because we are going bullish on discount levels, because that's where we look for sales. So these will be the area for us to concentrate on buying opportunities, not above this level, not above this level. So this is the level that we will be looking at, or we will be concentrating in terms of looking for buying opportunity, right? That level I have marked there. Okay, so that's what we have identified. So you go to higher time frame to identify, is the market bullish, bearish, or ranging? Where is liquidity being targeted? So in our case here, this piece of price action that we are going to study, right, from down here to up here, the market is bullish, right? So, and we have seen where we are targeting the liquidity, this buy side liquidity. That's where our target is, right? So then now you go to the lower time frame. Let's jump maybe probably to 30 minutes time frame. Okay. So before even we jump on the 30 minutes time frame, all right, I can utilize the 4-hour chart to mark my zones. All right, I can utilize the 4-hour chart to mark my zones. So when you look these on the 4-hour chart, right, when you look at these on the 4-hour chart, you can be able to see I've marked the premium and the discount zones, right, which also rhymes so much well on this 4-hour chart. So we can see that we have marked where we have maybe we can mark also the change of character here, right? That's where we have the price reverse at this particular point. So from downtrend to uptrend, right? And then now we see the price retrace down to this particular order block, maybe for an entry, especially maybe if you swing, you can take the trade from the 4-hour time frame. But so the second step is you mark higher time frame zones. So we have marked that premium, discount, we have marked where we have liquidities, and yeah, we can we have marked where we have the liquidities and all that. Okay, so now the next is to drop the lower time frame. Let's utilize the 30 minutes time frame, because I know if I go to the 15 minutes time frame, it might not give me the opportunity to view prices, because this is a free trading view. Okay, so now this is the 30 minutes time frame. What are we coming here to do? We are coming here to look at liquidity sweeps. All right, we are coming here to look at liquidity sweeps and market structure shift or confirmation, and also the entry models, maybe probably using the fair value gaps or the order block. So for this case, I'm going to use the order block because that's what I trade. So now when you come to this particular zone, you start now see how the price is reacting. So we start seeing the first sentiment here. We have that shift in market structure, right? We have that, and the price rallies up. So that is the shift in market structure. So this shows us or gives us an indication that the price is about to reverse. And before it reverses, see, it has already taken these liquidities. We see these liquidities being taken out, right? So the liquidities are being taken out there. Only that you cannot be able to see the previous one, but you see there the liquidities are being taken out, right? We have these sell side liquidity. Also, it created a BOS as it pushed on the downside. Okay, so we have that there. So it's very important to note that sell side liquidity. We can also call it a BOS. So now look at this case scenario. I know now with this one, someone might be waiting to buy here, right? Because this is an order block that maybe probably the price respected and it pushed on the downside. But when you are, I mean, to sell here, to sell at this particular point, but there is no need of you selling here, because if you sell here this order block, what it tells you is that you need to target the price to come to this level. So here now, that's where we said that you will find that the price, right, continues or reacts slightly, then now continues on the bullish trajectory. So the entry worked locally, right? But globally it failed because you're waiting for the price to come maybe to this level, right? But now the price just reacts here and then now it pushes up. So you should avoid those kind of instances. And that's how you filter trades, because you will see so many order blocks, so many of them. But now how do you filter and work with those with high probability, right? So the discount and premium tool helps us so much to filter that. So now let's look at it. We have that, and from here, therefore, we can use these as our OB, right? So the price comes to this particular point at what time? The first touch here is at 6 a.m., which is not during the kill zone. But we see another touch here at 10 a.m., which is during the London close. Okay, let's say maybe probably even that was not a bit clear, right? Maybe no trading opportunity there. But look at this particular scenario here. We have a very nice, right? We have a very nice BOS here. Okay, so we have that BOS. So the BOS shows us where the strength of the trend is. So when we see the BOS is forming on the upper trajectory, it tells us that the strength of this market is bullish. Okay, so these are the BOSs, right? So you can see that. You can also be able to see that. So these are the BOSs, right? Okay. So, and we can also be able to see this. It's a BOS here, right? Now, what we want to look at here is buying opportunities. So with this BOS, therefore, we see displacement of price. Remember, you have to look at all characteristics of a high probability order block, right? And then now we have our OB there. So the first OB there. So the price comes here at 7 a.m. New York time. That is during the New York kill zone. So, and you have your first entry, long entry at that particular point. Your stop loss needs to be there. Now, you can either decide to swing this until the price goes to the overall target that we have, right? The overall target that we have, that is where we are looking at these liquidities, right? This particular point, you can decide to hold maybe until the buy side liquidity that we have seen on the daily time frame, right? Or probably maybe you can have multiple trades in this particular case scenario. So we have that. If our entry is here, then where should our target be? this particular liquidity area here, right? That's how we should target. And you see the price comes to that particular level. Okay, so fulfilling the mandate of that particular structure. All right, because now we are learning ourselves on the bullish sentiment. Let's say maybe probably you did not get this particular setup. There is also another setup here with this BOS. There is the order block there, and the price comes here during 4:30, right, during London kill zone, and you still have another entry, right, another entry. So you can either decide to hold it to the bigger direction, all right, the bigger liquidity target that we are looking at. So or maybe probably you can decide maybe probably even to use all the way to this particular level where we have that liquidity, and then now you exit. So look at that. So the first one gives you a risk to reward ratio of 1:10, right, 0.71. The second one gives you a risk to reward ratio of 1:4.13, right? So you continue looking at them like that. So at this particular point, we see the price, of course, will tell us that we have a shift in market structure. So the market is reversing. So I avoid this kind of, someone could be selling here, but I usually avoid this one because the overall trend, the higher time frame buyers. Okay, so this will be like 50-50. You might get it, you might not get it. So I don't want to gamble here. So I'm looking at something that is high probability. So the price drops and takes out these particular liquidities at that particular level, and then now we see the market reverse, right? So we confirm that with this level here, the market reverses, and as it reverses, it comes now to so this one gives us an indication that market is going to go up. So we wait for it to come to this order block there, and then now we have another buy opportunity. So as you can see, I'm not concentrating on sales, because remember, I'm aligning myself with the higher time frame buyers. So the price comes here at 2 a.m. that is during the London kill zone. So where will be my target be? Of course, I'll be targeting these liquidities there. That's why we have the sell side liquidities, right? I mean the buy side liquidity, BSL. So from that particular point, we have that, and the target is hit smoothly. This is a risk to reward ratio of 1:3.96. Okay, so here is consolidation. Nothing much you can do in a consolidating market. Okay, so then the price pushes all the way down almost again to these particular levels here. And from this particular point, what we want to see, first of all, is a shift in market structure towards our directional bias. And there we have. And then now here we have the order block. We have that particular order block, okay? And you can see the market comes to the order block here at 8:30 during New York kill zone, okay? And now you have your entry. You can extend it even to that. The market revisits it again at 6:30, which is not really an entry because it's outside the kill zone, but the first entry is here. So you have your long position there. Okay, so then you have your stop loss there. So what are we targeting now? Come back again to this particular level. We have a lot of liquidities resting at this particular level. So my target will be around this particular zone. Okay, so you see this particular level, the price comes all the way to that particular point. So that will be my target, right? That will be my target. And you can see initially the price came all the way to that particular point. And that was a risk to reward ratio of 1:12.74. But within, you can be able to look at some partials when the price goes to half your target. Like here we have some liquidities, here we have some liquidities. So you can have, this is what I'm saying, this is obvious liquidity. So you can have these as your TP1. You can have probably this other one here, maybe probably as your TP2, and then now you have your TP3, right, like that. Okay, so now within this the price consolidates, but it initially moves, right? So as it initially moves here, we see another BOS, right? And that means that this is our order block. So we still have another opportunity to look for a buying setup here, and the price comes here exactly at 7 a.m. during the kill zone time. So this is how we get our long position. So we have that, we have stop loss there, and therefore we have targeting these highs here, right? Targeting these highs here, and that's a risk to reward ratio of about 1 is to 4.2. Okay, 1 is to 4.2, right? So remember, now we are pushing, so we are still pushing. All those are entries. So the price again comes at this particular point, this particular level here. We have the BOS. So we have these as our order block. See, these are last buy candle here. We have it as our order block. The price comes at that level during 4:30, 4 a.m. That is during the London kill zone. Okay, so and therefore you have another buy. You can look for a buying opportunity there. Your stop loss there, right? And what will you be targeting? These highs here, those obvious highs, all right? Those obvious buy side liquidity. And you can see the price comes to that risk to reward ratio of 1 is to 3. Okay, so then the price pushes on the downside, creates a shift in market structure. But again, at this particular point, the market creates a BOS, right? Here, the market shows a shift or a reversal now, and we continue pushing up. So sometimes it might push up violently, like in this case, no entry. So we still have these year consolidations, right? Consolidations happening at around that particular moment. So those are consolidations, as you can see. But now look at this particular point. We have that BOS, and we have this particular order block, right? We have that particular order block. So the price comes here at 10:30 London close, right? I mean London close, and you have your long position there. You have your stop loss there. So where will you be targeting? Probably these highs here, because these are obvious highs. So, and you see where the price came at that particular point. Okay, so a setup of a risk to reward ratio of 1 is to 4.1 is to 4, right? You can say that is one, basically 1 is to 4. So then now the price pushes again on the downside. Here we see the price tending to show us that it's going to push on the downside. So it pushes all the way down to this level, and it comes again to this OB, right? Though we don't trade order blocks for the second time, I like trading them the first time when they activated, and then now we see the price again pushing up, right? So maybe here, if you in this case scenario, what we can be able to see is that the price creates what, a BOS here, so showing us that we are now pushing up, and then now we have this particular order block here. So the price taps that particular order block 8 a.m. That is during the New York kill zone, and then now we have our long position here, our stop loss below here. So where is our target? We'll be targeting the price coming to this particular zone. So you can either decide, like I said, you can decide to swing it, right? You can even target these highs here, right? These particular highs, because they're almost two highs together. So, and you can see the price achieved that risk to reward ratio of 1 is to 4.76. Okay. So you can see now above this point, you're not looking for any buys, because this is the discount, is the premium levels, right? So we are not looking to buy at premium. Okay. So, and now you can see how the price is displacing itself. So three things or three steps to that will help for framework alignment, right? So identify the higher time frame structure. So you are looking at whether it is a bullish, bearish, or ranging market. Then mark higher time frame zones like the premium and discount zones. Then now you go to lower time frames. You look for liquidity sweeps, market structure shift or confirmation, and also the entry models, right? So, but only in the direction of the higher time frame. That is what you should understand. Only in the direction of the higher time frame. Okay. So why traders skip this step is you realize that most traders skip higher time frame analysis because they want faster trades. They rely on lower time frame signals. They chase immediate setups. But without buyers, you will be reacting, not planning. And reactive trading is inconsistency. Okay. So why am I sharing this? Because when I started trading ICT, I used to take every clean ICT setup I saw, every order block. I used to take every order block, right? But some could work, some could not work. And I asked myself, how can I be able to increase the probability of these particular order blocks? And that's now when I started filtering out the entries using these criteria that I've shared with you, higher time frame buyers, and my win rate improved, and my losses now started making more sense. All right, because direction helped me to clarify my execution. Okay, so in a nutshell, what I'm trying to say is that higher time frame bias defines direction, filters trades, and improves probability. Lower time frame entries refine timing and optimize execution. And without bias, you'll have random outcomes. With bias, you'll have structured decision. So trade the bigger picture. From today, start trading the bigger picture, the higher time frame bias, and execute on smaller time frames. Right. So in the next video, I'll be breaking down how institutions use news while retail traders panic, because understanding how news impact liquidity can completely change how you view market volatility. So until the next one, keep safe.